Well, Federal Reserve Chair Jerome Powell stated on Tuesday that the U.S. central bank would have lowered interest rates by now if it were not for the tariffs imposed by U.S. President Donald Trump and the White House on trading partners around the world. Trump's pressure on Powell has contributed to a decline in the value of the dollar, many critics say, as U.S. debt markets appear to be losing their safe haven appeal. For more, let's welcome JoAnne Bianco, Senior Investment Strategist and Partner at BondBloxx. JoAnne, thank you very much for joining us. What do you make of this sour relationship between the U.S. president and the Federal Reserve Chair?
Well, we understand that the Fed doesn't want to reduce rates until they have more data, and they don't. If they feel like inflation could eventually surge from these tariffs, they don't want to reduce rates in advance of a potential surge. So we definitely understand where the Fed is coming from in that respect.
How many Fed rate cuts do you expect by the time 2025 is over?
Well, it looks like, certainly the probability estimates are that we could see up to 3 rate cuts starting this fall. So at the September, November, and December meetings. But, it's possible, in our view, there's the potential that it could just be 2 of the 3 rate cuts. It's most likely that we will see some rate cuts if we don't see a huge sustained increase in inflation. But going all the way to 3, a lot of times the traders' estimates have been very optimistic about the number and timing of rate cuts here in the U.S. over the past couple of years, and we think that could continue to be the case right now.
Tomorrow, as you know, we will get new U.S. non-farm payrolls numbers, i.e. the crucial employment report. The Fed watches this very closely. Of course, employment is part of its mandate. What kind of deterioration in the labor market would be sufficient, do you think, for the Fed to move?
I think they would have to materially weaken from, they're softer already, but they'd have to materially weaken from here for the Fed to take action sooner than we expected.
Okay. June was another good month for the U.S. fixed income market. Tell us what you saw.
Fixed income has been a great area in the U.S. This year. It's benefited from higher yields across a wide variety of asset classes without the same volatility that you've seen in equities. So if you've picked your spot in fixed income, maybe focused on credit markets or intermediate treasuries, you've done very well in the U.S. this year in terms of return.
What about corporate debt? How's corporate debt performed? We hear a lot about
very
narrow spreads between the yields on corporate and sovereign debt.
Right. Yeah, no, that's what I meant by credit. Corporate debt in the U.S., triple B rated debt, high yield, double Bs in particular in the high yield market have done very well. And what they have is, just an underpinning of fundamental support in terms of balance sheet strength for corporations. There's a lot of reasons why the U.S. corporate markets continue to hold up. There is good fundamentals for corporates right now, and that continues. And so it's supportive of a very attractive environment for corporate credit debt.
Is this a good time for investors to include high yield corporate debt, so-called junk bonds, in their portfolios?
Absolutely, and we don't really refer to them as junk bonds.
Understood.
But yes, definitely, because the corporate default rate is expected to remain well under the long-term average, and basically since the pandemic, you've seen companies focus on debt refinancing as opposed to doing like aggressive capex spending or leveraging their balance sheets. So they're in good shape from a fundamental perspective, and that is very supportive of, the additional income that you can get in terms of the higher yields and higher spreads over treasuries in corporates, in high yield specifically.
How does the fixed income market view the large tax and spending bill now on its way from the Senate to the House of Representatives? There certainly is alarm on the part of many observers as to what this would do over time to the U.S. fiscal deficit, expanding it to some $3.3 trillion.
Yeah, I think that's why when we make our recommendations, especially in the U.S. Treasury area, we're more focused on recommending short to intermediate maturities because we think the long end of U.S. Treasuries could continue to be more volatile, and that's one of the areas where you could see more volatility based upon the tax and spending bill.
Okay, why don't we finish with emerging market debt? Is U.S. dollar weakness a positive for U.S. Is U.S. dollar weakness? We're looking at the dollar index now, down substantially from January to the present day. Is U.S. dollar weakness a positive for emerging markets sovereign debt?
It's been a positive so far this year. That's actually been one of the best areas of performance in all of fixed income, and we see that because we have an ETF that tracks a 1 to 10 year emerging markets index, and it's our top performer in terms of return over 6% in total return.